Nervous about the volatility of public markets? Looking to invest in Canadian real estate but not finding the right opportunities? Neighborhood holdings may be an option. Nearly 10 years of consistent performance, Neighborhood aims to provide stable income while preserving invested capital, target net yield above 8%. At the heart of the strategy is Neighborhood's mortgage product portfolio of first position 100% residential mortgages across Canada with an average loan to value under 55%. Neighborhood partners with mortgage brokers and financial institutions to support quality borrowers in transition who may not currently qualify for traditional financing and have a temporary need for capital. Neighborhood's portfolio has no exposure to commercial, construction, or bare land properties, is geographically diversified across major urban and suburban centers in Canada. Check out the links in the description or visit neighborhoodholdings.com to view the offering memorandum for investors and advisors or to explore mortgage broker partnership opportunities. This is not advice. Please consult a professional advisor before investing a loonie in any of these investments. Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble.
Welcome back to the Loonie Hour, episode 215. As always, joined by the three amigos, Boomer over in Halifax, Rich Diaz, Montreal. What's going on?
What's up?
Richard.
How's it going, everybody? Not much. It's cold and snowing. I scored a goal in hockey, but the real thing I wanted to tell everybody about is I'm a big fan of art, as you guys have known, and I went to an amazing show the other day in Montreal. And it was this guy called Monkman. And his name's Kent Monkman. He's an Indigenous painter. And he's really big time in Toronto, New York. And I absolutely could not recommend the show, the vernissage, the gallery, as it was just amazing. And I wanted to read the review that I gave to my friend, which was that it was beautiful, revisionist history and woke propaganda, but I could not take my eyes away from it. Honestly, I could not honest to God, I could not recommend the show enough. So if you guys live in Montreal, it's downtown, go to the Montreal Musée des Beaux-Arts and you'll see one of my favorites. I actually bought a poster. I'm going to put it on my wall. Is this one. So there you go. This is not the poster. This is like a postcard. But anyway, yeah, that's it. That's all for me this week. His name's Kent Monkman. I think he's Canadian. And I could not recommend his show.
Sounds pretty similar to my weekend at the Buffalo Bills game.
Well, what do you mean?
I went to a Buffalo Bills game there a few years back. Was it enjoyable? Quite the experience.
Oh, it is wild. Yeah. There's Keith, you prepped me for the vacation. And there is nothing going on in that city besides the Buffalo Bills.
How's the tailgate?
But the cocktail bar with the charcuterie served at halftime in the stadium, that's quite enjoyable.
The chicken wings are good though.
But tell us about the experience. Like, did you show up early? Like, did you jump on a table?
Yeah, we flew in like a day before. We tried to go to like Josh Allen's favorite chicken wing bar, and it was like an 80-person lineup. So we went across the street and waited an hour there and had some chicken wings are amazing. But then there is nothing to do in that city. It's crazy, man. Like, it's funny. Obviously, being a real estate guy, you're looking at Zillow. Like every house in Buffalo is like $175,000. Wow. So very, very affordable housing. If you're looking for affordable housing, they have it in Buffalo. But
you rent out your house 8 times a year.
We rented the crappiest house. Well, actually, to be honest, it was like one of the nicest houses on the block, but it was like $600 a night.
Wow.
So, if you're buying the house for $175 and you're getting $600 a night,
is that good?
I think that's pretty good.
Loonie Hour math.
But just to be clear though, everyone, you're only getting that $600 a night for 8 weekends a year for each home game. That
goes down to $20 a night.
Yeah. How was the crowd?
So speaking of football, I prepped everyone for the UTEC Bowl between the St. Mary's Huskies against the Montreal.
Everyone's dying to know the outcome. What happened?
I don't know what they're called, Rich.
Did you run down the sidelines again?
The Caribbean.
It was,
Carabin? I think it's called the Montreal Carabin.
Yeah, that's who they were. That's who they were. They dominated. The Montreal guys dominated. So, but it's a real good turnout for the neighborhood, and it was a lot of fun. So now Montreal, they go to, guess who's hosting the Vanier Cup this year? Which province?
Saskatchewan Roughriders.
Yeah, it is. Well, not the Rough Riders. It's just Saskatchewan. They're hosting it. Okay, that's enough of the.
Hold on, you forgot the biggest announcement.
Yeah, let's go.
What's the announcement?
Saskatchewan Rough Riders, Grey Cup champs.
And we got a pipeline.
Well, not yet. We were told we were getting a pipeline announcement on the Grey Cup or before the Grey Cup. It's still mostly just leaked stuff on the mainstream media, which is effectively we're supposed to be getting a memorandum of understanding that there will be effectively a pipeline on the project list between Alberta and the federal government. But I'm kind of Rich. What you probably would know? What is a memorandum of understanding? Is that actually like? Is that just like someone wrote a piece of paper and was like, "Someday we promise we'll do a pipeline"?
Yeah, it's basically agreement that we might go on a date at some point. Rich, you get a lot of these, don't you? I think in your world.
I thought it was like it's like when a girl asks you if you're going steady, and you're like, yeah, I guess so. But that's not the major announcement for in Canada this week, Steve. Come on, you know what it is.
Which one is it?
On December 2nd, the Loonie Hour is we're gonna have an investor series in Toronto, Ontario.
The Loonie Hour Investor Series. It's a new sort of event presentation style. We have friend of the show coming to join and present, Ben Rabideau. So it's effectively private presentations on Canadian housing, global economies, markets, and investment strategies to protect and grow your wealth. That is at the Toronto Cricket Club. I believe tickets are $40. There's an Eventbrite link in the show notes, and that includes drinks, appetizers. So it's definitely not a moneymaker, but it's a good opportunity to come meet everyone, minus myself. And yeah, I mean, chat markets, learn markets, charts, et cetera, et cetera. And what else, Rich? Free parking.
Free parking. Very important for Toronto. Very important.
So, I mean, basically you're losing money if you don't come.
And just to be clear, Steve won't be attending because of his schedule. He's already, blown his Toronto budget going to Buffalo.
That's right. He chose to go to the Buffalo Bills. Did they even win? You didn't even tell us the score of the game.
It was an amazing game. I don't know what the score was. They had like 45 points though.
Okay. That's good.
Anyway. And he had nice seats. We were like chatting sort of, and Steve had real nice seats. He was close to the action.
Yeah, I had a Kleenex for all my nosebleeds up there.
Okay, Steve, line us up for the week. What are we chatting
Well,
this week?
it's funny. We did a podcast. Well, we got some Canadian housing data this week, Canada's CPI, U.S. data. We're finally back with the U.S. data after the jobs shut down. Financial markets updates. Obviously, lots happening in markets. Crypto's getting killed. Stocks are coming under pressure. Things happening in the Japanese bond market. So lots happening in financial markets as we head into the year end. But there's one thing I wanted to flag before we sort of jump into everything. Last week, we brought on a guest, Brian Kingston, who was, what would you classify him as, Rich? Like,
he's a lobbyist.
He's a lobbyist of the Canadian
auto sector.
Basically for the Canadian auto sector. Anyways, I thought it was a really great conversation. And it's funny enough is like we talked about like how unrealistic these, EV mandates were, and it was never going to happen. Effectively, what you're going to have to do is these sales targets were ultimately going to require Canadian auto manufacturers to actually end up rationing auto sales. So that would ultimately send new and used car prices even higher. So we've, obviously this can't continue, but it was like a couple days after we dropped that podcast. I don't know if they were listening or not, but the BC government, first out of the gate, the BC government is announced it is scrapping its zero emission by 2035 mandate. As Energy Minister Adrian Dix said, the 100% sales goal by 2035 is, quote, no longer realistic.
What he meant to say was never realistic.
It's
No longer real. Yeah, that is
like
the key point with it. What else did he say, Steve? Did they?
I
pick
mean,
another
basically,
date?
so effectively, what they basically said was they are no longer going to be doing like EV subsidies, like rebates. So again, as an EV driver myself, in the heyday, this is like when I first got my EV, I was like, this is kind of a no brainer. You could go to the federal government would give you $5,000, and the BC government would give you an additional $3,000. So you'd get like $8,000 off your car, right? And then you combine that with like very cheap hydro prices in BC, and it's kind of a no-brainer because BC also has like the highest gas prices in Canada, or one of the highest gas prices. So it was kind of a no-brainer. So the BC government now has basically eliminated that $3,000 rebate, and they're like, we're not doing this anymore. I mean, they can't afford it. We're running a record budget deficit right now in British Columbia. So that's being scrapped. And they basically said in the announcement that they're going to leave like EV mandate rebates to the feds. They're like, if you guys want to cut checks, you can cut checks, but like, we ain't doing it anymore. So,
What
and
are
I think
what are all the rich lefties going to do?
it's crazy, man. Yeah, I think so. Rich, I could be wrong, but I'm pretty sure BC has like the highest EV adoption rate in Canada.
Ooh, I don't know that. I'd have to Google that.
Given I'm assuming given climate, given overall wealth in the province, given cheap hydro rates, I can tell you like every third car in Vancouver is like literally a Tesla.
Interesting. Yeah, I mean that's a good guess. If I had to guess, I would have guessed.
That's my guess. BC. Correct me if I'm wrong in the show notes or in the comment section there on YouTube, but I'm pretty sure BC is the high. Anyways, you can actually see that. As we talked about in the pod, EV adoption rate has been falling over the last 12 to 24 months, effectively because, Rich, I think we're in a cost of living crisis, which is people are buying what they can afford. And when you start removing $8,000 in subsidies, the cars are very expensive.
Yeah, I mean, the one thing, but so that's true. One thing I want to point out, we totally whiffed on this, and somebody wrote us an email, and they were 100% right. We forgot to ask Brian about hybrids, which was such a stupid mistake on our part, because I think that's like something that just like is in my view ignored, frankly. But I know that there's some big auto companies like Toyota that years ago they said, "Oh, the EV thing is bunk. We're gonna stick to hybrids." And I think,
but it wasn't though a hybrid. It was just really the first attempt. Like it's the evolution of going to a full EV.
But there's some a lot of the issues that people have with EVs are dealt with very neatly with hybrid, which is range anxiety and heat and cold weather issues, et cetera, et cetera. And that's why
isn't it also, if you have a hybrid, of course, we're going to get lots of listeners to say, hey, this is the right way to view it. It's my understanding, though, now you have twice as many things can go wrong with your car instead of just one.
Their Japanese cars are amazing. What are you talking about, Keith? This is not some like 1980s, like, Berlin-made BMW, with the fun boys down in Stuttgart. These are like Japanese cars are extremely reliable, and the hybrids are done really well. And he was
so Rich wants it both ways, it seems like. Steve is full on an EV, and I'm in the gas guzzler over here.
Well, I mean, you have the dirtiest grid in Canada, don't you?
Yeah, I know. That's the best part about this whole story. 60% of Nova Scotia's energy is coal. Anyway.
Oh, what else? I have another funny story for you. Another thread that we've been pulling on. More recently, we've been talking a lot about the Cowichan First Nation stuff. We got a couple more land claims that are coming out. So we talked about Richmond, obviously my dear homeland being first out of the gates with the case precedent being set by the Cowichan Nations. We talked about the city of Kamloops, which is 100,000 people, is now entirely under effectively dispute right now, or going through litigation. Friend of the show, Brad West, mayor of Port Coquitlam, was out tweeting. He says, the city of Port Coquitlam is the subject of a land claim by I'm not even going to read it, the First Nation. I don't know how to pronounce it. The properties are fee simple properties owned by the city. One is Gates Park, home to our premier athletic fields. The other are a series of smaller undeveloped parcels referred to as South Shaughnessy. It's important for our residents to know two things. We have and will continue to vigorously defend public ownership of these lands along with private property rights in our jurisdiction, and we will ensure the public remains informed. So
is he the first, I guess, government official that sort of, it sounds like he's taking a bit of a harder stand on this?
He's taking a harder stance. I think he's a terrific politician. If he's listening, which I'm sure he is, I think he should be running for premier of BC, but it's a conversation for another day. I think they came out along with Richmond saying, listen, we no longer do land acknowledgements for obvious reasons. They're publicly fighting it. But that's one story. The other one that I found really interesting, this was in the Globe and Mail yesterday, actually. So the Alaska First Nations tribe claims they are, quote, Aboriginal peoples of Canada, and they want to say over Canada's natural resource development. And the article goes on to say a group of Alaska tribal nations is going to the BC Supreme Court to demand a seat at the table in Canadian resource development, including a mine expansion that is among the nation-building projects Ottawa has selected as pivotal to economic development. The Alaska groups argue that their historical use of what is now northwestern BC makes them Aboriginal peoples of Canada under the Constitution Act, saying that status should guarantee them the same rights to consultation as Canadian Indigenous groups.
Makes total sense.
Yes, I agree. You can see where this is going, of course.
It's just a total.
It's just like there's no end in sight. It's just like it's endless. Like everyone that has a figment of an imagination of a former claim is coming out of the woodwork saying, well, I'm going to get my hands into the pot.
Even people from literally a different country.
Yeah. I mean, the argument, if you go through the article, is effectively that back in the day, before there was like a border between Canada and the US, the land effectively was like split. Effectively, what they're saying is someone drew the border. And
yeah, all borders are arbitrary, basically, except for coastlines and rivers.
I'm not going to back or support this, but that is the current counter argument.
Interesting.
So there you go.
Okay. Of course, all this could end in one afternoon press conference. That's all it would take to stop it in its tracks. Okay, what else do you have, Steve?
What else we got? Housing. Rich, did you say there was an article you want to talk about with National Bank?
Yeah.
Who we do like, by the way. We do like National Bank. They do some good research, but they had some thoughts on the housing market.
Well, yeah, I sent it to you and you fell out of your chair because the headline from, again, National Bank, friend of the show, we actually rip off a bunch of their stuff and they do really, really good work, which is why I sent it to you in the first place. Because when I saw the headline, I was like, oh shit, we got to pay attention to this. And it said, so the headline is Canada home prices continue their upward trend in October. 8 of the 11 CMAs, which is what? Metro areas?
Census metropolitan areas.
Thank you. Included in the index saw increases. Quebec City, Winnipeg, Ottawa, Gatineau, Victoria, Vancouver, Edmonton, and Toronto and Calgary. Prices were stable in Halifax and in Hamilton and declined in Halifax. Sorry, Keith. And they were down in Montreal because the Habs suck now. But anyways, I just thought it was really interesting. So they have all this data, and I just wanted to know what you were. I
think we can riff on this briefly. I mean,
yeah, please.
I think this is the challenge when you look at like a benchmark of home prices, and then you start seasonally adjusting it and saying, "Whoa!" Like, I mean, I'll tell you this: like, home prices don't really like move on a monthly basis. Like, it just takes really time. Like, housing is very slow moving typically. So like you don't go down in home prices for 7 months and then like next month they're rising again. Like it's kind of like when housing markets turn, it's kind of like a cruise ship pulling a U-turn. Like it's slow. It takes time. So this is the challenge when you have like economists sitting in an office like in Toronto and then they're pontificating on like what's happening in Vancouver and Calgary, for example. Like it's just. You really have to be like on the ground to be able to filter out, I think, a lot of the noise. And I think that, in my opinion, that's mostly noise.
The other, like, I can tell you, just Oh, sorry. Go ahead.
Well, I can tell you without a question of a doubt in my mind, Vancouver home prices are still correcting. Toronto still correcting. Calgary is correcting, and I think is actually accelerating to the downside. I can't speak for like Ottawa and Montreal. It's just markets. They're just not markets that I watch that closely. But I would say, like, when you start looking at Vancouver, Toronto, Calgary that are unequivocally moving lower, those are like 3 of your 4 largest major metros.
Yeah.
It wasn't the gist of the research piece, Rich. It was positive.
Yeah.
For real estate in general. And as Steve is saying, well, I read it as well, and I sort of squinted hard at it. Held it upside down.
Well, that's what I mean, yeah, in our business, you always have to challenge your sort of preconceived notions. And obviously that's why I thought it was interesting. I think the other thing that you've mentioned to us before, Steve, is because it's illiquid, when you don't have transactions, you can't get visibility on the price. Is that still the case? So if literally people aren't transacting, then any price signal you get is not a true price
There's
signal.
a lot of people that right now that like are trying to sell, they want to sell, they're reducing their prices, but even still, you're not getting a bid to trade and sell. So I think that's still the dynamic in broad swaths of the market. The pre-sale side is still ground zero. We're hearing like default rates in pre-construction condos around. So in the GTA, we're hearing around 20%. In parts of Vancouver, it's between 10 to 20. So effectively what that means is like, and again, it is for fairly select product types, which is like, okay, I'll give you an example. Like if you bought a high rise condo near the peak of the market in the suburbs of Vancouver, so the Fraser Valley, if you bought a high rise condo there, you just grossly overpaid. And so those condos are now coming for completion, and we're hearing default rates between 10 to 20%, which means people that put down, 10 or 20% deposits are simply just walking away. They're saying, I'm not closing on this. Like, you can come sue me.
Wow.
Yeah, because
where's that for, Steve? I missed which market.
GTA is high. We're hearing close to 20% there, and then in large parts of Metro Vancouver, it's between 10 to 20. It depends on the project, right? Like, if you bought a high-rise condo at $1,200 a foot in Surrey, like, yeah, your default rate's probably 20%.
And this is widespread. It's not just 1 or 2 projects.
Yeah. So like obviously the blanket appraisals was helping a lot of these projects get across the finish line, but the blanket appraisals are tightening up a bit. They're obviously under heavier scrutiny now from the regulator. And so we're seeing.
So I'm assuming loan to value then for a lot of this stuff now is 100%.
Yeah, for sure. Yeah. So it's like, what I mean? It's like people like, if you put down your 20%, let's just say, I'm spitballing numbers here, but let's just say you bought a 2-bedroom condo for $1 million. You put down 20%, but like, what does the condo appraise at? Like, and so like, there's just that, and that's the challenge is like people are having to come up with excess cash or excess liquidity, and they don't have it, especially if you bought 2 or 3 of these things. Right. So many cases, you're just walking away from $100,000 or $200,000.
That's a lot of money.
That was like the young lady in The Big Short. She had several units.
It's a problem. It's a real problem.
Margin Call is a better movie. That's a lot of money though, Steve. That's like $200,000 or whatever. You're walking away, just you're gonna vaporize that cash.
Yeah, if you can't close, and because like the challenge too is some of these units, right? It's like you're underwater, and you're not gonna live in it. And you can rent it out, but like if you rent it out, you're going to lose, whatever, $1,000 a month cash flow, $1,200 a month.
Right.
Like, you know what I mean? It's like, okay, well, like,
it's not an investment. You don't want a negative carry on any investment unless
they're German bonds.
Well, people, it's funny. People wanted negative carry when mortgage rates were 1.5%.
Yeah.
Not so much at 4%.
But it works when prices are going higher. As soon as prices are, that's something we'll go into now as well with markets and everything. It's amazing how We haven't called it this. So I assume we'd call it a bear market in housing. That's what you want to call it now.
It's been almost 4 years of a bear market now.
So it has a ripple effect on everything. Now we're starting to see it on the other side.
Keith, just to touch lastly on housing before we shift gears here. Get some good research from Ben, who's obviously again going to be at the investor series there in Toronto. But so he notes the most recent Korea data that came out a couple days ago here for the month of October. Canadian home sales were up 0.9% month over month in October, the sixth increase in the past 7 months. So I think that kind of echoes where maybe National Bank is getting excited that, yes, I think it's fair to make the assumption that demand has bottomed, right? Like demand itself has bottomed, but like you're still dealing with very high levels of inventory, very high levels of new listings. So if you look at new listings on a 12-month rolling basis, they're running at record highs. And so I think that's the big challenge is that, yes, like home sales after running at effectively 10 to 20 year lows across many major metros, yes, they've bottomed, but you're seeing still very high levels of new listings and inventory that it's just, there's so much inventory to clear that's still putting downwards pressure on prices.
Okay.
So that's kind of what we're seeing, but yeah.
So it takes a while. I mean, it takes a while for this to cleanse itself, to clear. And it's, I mean, if the economy stabilizes, then it will get better from where we are now. But the economy is still not getting better. I mean, we're still seeing data that we're...
Well, I don't know about that.
Grinding.
I think generally the trend, Keith, is that you're right about the trend, but there are some decent data points here and there that are kind of going against that overall view. I mean, I think the trajectory where we're going to end up is still where you're suggesting, which is recession, weakness, higher unemployment. But last week we got a decent employment print, even though it's a bit fuddy-duddy. And then
last week you said it was a horrible print. You're going back on your Loonie Hour word.
No, that's not what I said. But anyways, the point is that it's not, I think that's often the problem when you do get these cyclical declines, you get sort of, you do get some noise, is what I was trying to say. And some of the noise is strong PMI.
But to go back to last week's employment number for Canada, just so everyone can sort of reset, the headline number was good, but it was predominantly part-time jobs that was coming out of it. And you did a very good job explaining, hey, that's not a long-term investment by a company. That's a short-term, Band-Aid. We're going into it. But I mean, but the overall theme here, I'm not saying we've reached a bottom or a turn yet at all. And I'm still, maybe you think a bit differently about it, but I'm not seeing any indication that we've bottomed from an economy or housing market for that matter.
I agree.
I mean, if you're from our conversation with Brian from last week, if you're working in the auto sector or one of the knock-on sectors from it, you can't be sitting there saying, oh yeah, I'm going to max out my credit card this Christmas. You're fearful of what's coming around the corner. And it doesn't mean something bad has to happen, but as long as you have that lack of confidence that, that you are going to get a bonus, you're going to keep your job and all that, then if you have the confidence, then you will spend. If you don't, you're not going to spend, you're not going to buy the home, you're not going to close on the pre-con that you committed to.
We love a pre-con.
Pre-con, yeah.
What's going on with Rich with Canada's CPI data? We had that out.
I love a good CPI print. It was really interesting. I mean, I'll go over quickly if you want. So
don't bore us.
I won't bore you. I also won't tweet. Whenever politicians tweet triumphantly about anything, you should always be very suspicious because they almost certainly haven't done the underlying work. And inflation, I mean, it fell in the sense that it went from 2.4% year on year to 2.2%. That's the headline number. But I think what's really important to note is that the core inflation numbers continue to rise. So there's different types of core, as we've talked about. There's the three preferred measures of CPI. Two of them actually fell. Again, they're still high. They're above or at the top of the target range. You got the one weighted mean fell to 2.9. the trimmed mean 3.30, and the other one is at 2.7. So they're still relatively high. But what was really interesting actually was there's another core measure which just continues to tick higher and higher and higher, which is when you take out the there's indirect taxes, obviously, that people are aware of, which is like which happens all over the economy. And then there's obviously volatile components. And so when you strip out that stuff, this is an important series because it really shows you sort of the central tendency of prices, and that continues to rise. So that's at 2.9% with seemingly no end in sight. I think the real drags, just really quickly, were energy prices that fell because of gasoline and overall prices of energy. And then obviously the rent component just continues, Steve, to just hold up. It's basically detached from reality. It's lies. I don't know if it's lie. It's not lies.
So Rich, So Rich, for the headline number that it brought it down to the 2% range. That was drag. That helped. Was it energy prices that caused it to go lower?
Yeah, energy prices were the real drag.
And then when you strip energy prices out, as well as food prices, that's what you want to do.
Because food. But the thing is, so if you strip out food and energy and a couple of other and the really volatile components, we're seeing inflation continue to rise. And if you look at the most important macroeconomic model that's ever been created, the ICE cap inflation model, it's also suggesting that we're nowhere near the end of this sort of inflation.
Sort of like, is it safe to say you're kind of stabilizing at like 3%?
Yeah. I mean, it's funny. We did, I mean, years ago, I think like episode 89, we joked that like 3 was the new 2. And I think that was actually quite prescient. And I think that is absolutely still true. I think that they're never going to say it. I've gotten some pushback online from defenders of the BOC. I'm normally that guy, but I think that's what we're seeing. The other thing I thought was really interesting was meat prices continue to rise. We're going to eat the bugs, boys, not because we want to, because it's the only thing we can afford. Meat prices rose 8% year on year, which is really, really high, quite crazy. It's just more of the same. The other thing I thought was really interesting is on the back of that inflation print, or maybe it was rising bond yields. The whole overnight index swap curve, right, which is the forward expectations of the Central Bank of Canada's policy rate decisions, is starting to creep up. So not only are there like virtually no cuts priced in over the next little while, we're actually starting to see rate hikes being priced in. So I think that's kind of funny.
Speaking of this, have you followed the story that's developing on like chicken prices?
Yeah.
So like for anyone that's not paying attention at the grocery store, obviously beef has become incredibly expensive. So there's been a shift to people purchasing more chicken.
Right.
So chicken prices right now, per the CPI, I think we're up 1.5%. But wholesale and spot market prices have surged, leading to immediate retail hikes of roughly 12 to 15% overall, and up to 20% for popular cuts like thighs. And there's experts warning of further increases of 20 to 25% over the next several months.
Yeah. What's wild is in the actual CPI release. So they say, grocery prices rise at a slower pace. Okay, fine. They've fallen from 4%, but like there's actually kind of a line. They actually talk about fresh and frozen chickens. It's actually really, we make fun of Stats Canada, the random number generator, et cetera, but there is incredible detail in the CPI reports if you're willing to go dig through it. And they actually talk about how it was they just say 1.5% increase in September.
Okay, yeah, I wasn't sure if that was year over year, but
So just in September, that's an enormous increase. I know 1.5 doesn't sound like a lot of money, but on an annualized basis, Loonie Hour math, that's like a lot.
1.5. But what's great about this for everyone listening is that we call this the substitution effect. Right. So if one item becomes so expensive, you just don't buy it as much, or the amount you buy is low, or the frequency, or you just move away and buy something different, and then suddenly the new thing you're buying, in this case is chicken, that's now going up in price. And it just demonstrates that this inflation problem we have, or challenge, or crisis, it ain't getting better at all. So we've been on the case now for a while with the view here on the podcast that in like as you just said, Rich, 3 is the new 2. So I think we were right about that. And 3 is probably where we're going to end up at the best case scenario. So now all of a sudden, what's going to happen with the Bank of Canada? When's the next meeting, by the way? When's the next Twinkie bet?
Shit, I had it, and I screwed this up.
The December. I think
it's a December meeting.
Yeah.
It's
market odds, no more cuts, right?
There's no. It's 90% of no cut or something like that. I can check in a second.
So they will not be hiking rates in December, by the way,
right?
Unless something extremely traumatic happens.
No, they won't be hiking. They won't be hiking. Excuse me. Sorry.
Yeah, I know. I'm just saying that for not for you, Rich, but for the audience. Maybe for you as well. But Steve, it's a great point here in that we're going to be going through this economic scenario where maybe there is no sharp recovery. It stays. If you have your job, you keep it, but you're getting a bonus or as big as the one you had. You just sort of trot along here. At the same time, debt loads continue to go higher and higher, and prices of stuff goes higher and higher. So once again, income is not going to be rising at the same pace as prices, and it just creates this sort of awkward experience where it is going to self-correct.
How much of this is like? How much of it is like inflation versus like a currency debasement, right? So, which is to say, like, do you ever look at like the Canadian dollar against a basket of currencies, like
every day?
I mean, yeah. So, what's the performance like as of right now?
Very bad. I'm laughing because it's not funny, but it's just like it's abysmal. I mean, the Canadian dollar has basically fallen against every major European currency. It hasn't fallen against the Japanese yen over time because the Japanese have been actively trying to devalue their currency. They would.
Canada is devaluing as well, but we're just not aware of it.
Exactly.
They don't realize that's what they're doing.
Just for context, I'm like, correct me if I'm wrong. I don't know the exact number. Hasn't the yen fallen like 50% against the US dollar over the last?
Right. But we don't really import much from Japan anymore, and we don't really export. There's really small trading partner. I mean, the issue is, Canada's fallen just really quickly, Loonie Hour math. I mean, we're down something like 20% versus the Swiss franc over the last, let's say, 5 years. We're at basically another 10-15% low on the euro, even against the British pound, which is a basket case country with all kinds of productivity issues, growth issues, debt issues, inflation issues. We're at a 5-year low in that currency. Virtually every trend, so there's different ways of looking at trends: 200-day moving average, 50-day moving average. They're all going down. That's in part because the Canadian dollars, when you do look at the Canadian dollar versus a basket of currencies, it tracks oil because Canada's a petro state, despite what Mr. Carney might have you believe. And so that those are partly but we're now starting to. The gains that we made against the U.S. dollar are starting to claw back. The U.S. dollar's clawed back those gains, and so we're just down across the board. If you look at the trade-weighted currency, and of course that affects, right? Because what does Canada do? We export oil, we import consumer goods broadly, and so if we're paying more for those consumer goods in Canadian dollar terms, then it hurts us. But there's one more tiny little thing, which is the way that you can deal, and it's really important because it touches on my favorite subject, which is productivity. And the Bank of Canada, one of their deputy governors, not Carolyn Rogers, so it might not be the best paper that's ever been written on. No, I'm joking. But his name's Nicholas Vincent, and he came out, and there's been another paper on productivity. And again, what they talk, and he talks about the lack of productivity, why, how to remedy it, the limitations of the Central Bank of Canada in its ability to fix productivity issues. But in that paper, which I've read and I keep next to my bedside table, on my bedside table, is a section on productivity and inflation. And one of the ways that you can overcome higher inflation or rising inflation is by improving productivity, right? And that's why it's so important. And that's why I think if Canada continues to be in a productivity emergency, that inflation will not get remedied until we have a severe contraction in aggregate demand, which is not good.
It's normally when you have your currency that's declining so much, you have this like it's self-correcting eventually.
Yeah.
So whatever we're selling in Canada, eventually it becomes so attractive for other people to want to buy it, and But what do we sell besides oil?
Aero parts, agriculture products.
It's a sort of crossing the border back and forth, everything. It's just, again, it's a challenge that we have here. But it's something that we watch, every single day is on the currency side, which every investor should. And you shouldn't include it like on top of your stocks you're buying or commodities or something else. But as Rich just demonstrated, that the weakness in the Canadian dollar, not just against the US dollar, but against all these other currencies, it is showing a sign that we have a serious challenge with our economy. It doesn't mean something has broken yet, because if it's broken, it wouldn't be a gradual decline. It would be
20%.
You hear it? Am I snapping right? You hear that happening. It doesn't come across. But yeah, Steve. So, maybe your Buffalo Bills game, you zapped up all your US dollars to go to that one.
I won't be able to even afford to go to Buffalo by next year.
And that's a cheap place.
Keith, tell us what's going on, like market wise. I mean, obviously people are watching this and going, Bitcoin's down both 30% over the last couple months. That's a usually pretty good sort of risk on, risk off indicator. I think the NASDAQ's down 6 or 7%. So lots going on. What's really catching your eye these days?
Yeah, it's, this year, depending on where you were invested, some people who, they don't care about risk. They're just all in one part of the equity world. They've done very well. And other markets have done quite well. But there's really, from our perspective, we would say, hey, there's no risk in the market. And one of the biggest drivers of pushing any kind of a market higher is liquidity coming in. And the moment liquidity starts to slow, all of a sudden there's not as much money able to buy something. And then eventually you have less buyers than sellers, which, this is a very simple perspective. And all of a sudden things start to roll over. Now, most retail investors, not institutional guys, but you always measure the value of what you hold at the peak. So, Steve, I know you hold some things in your mind, it's worth this, because that's where it was at the peak. And people don't say, well, a year ago I paid this for. Third line if they say that. You always measure everything from the peak. And as soon as something gets triggered and starts to sell off a little bit, then people get a bit worried. Okay, it's going to bounce back. And as soon as something doesn't bounce back, then it just sort of gets reinforced and people start to sell everything. So right now, I think most equity markets are off, Rich? 3% from their high, maybe? This is not a big serious sell-off at all. This is simply just a pause in this uptrend we had. But gold is also off from a high. Oil is off from a high. The bond market is off as well. The only thing that's really increasing is the US dollar. And that is a sign of now a flight to quality. But the biggest, I guess, trend that we're watching quite closely, which we'll talk about at the event in Toronto coming up, it's really the underlying what's happening in the financial system. Whereas most people look at the stock market every day, you have to look at and see what is the size of the monetary base? How much is in reserves by commercial banks? What's happening in the repo market? So banks lending to each other and the cost of that happening. And I know Rich has done a lot of work on this about a week ago that we're sharing with each other. And we're now at a point where if you're looking at the amount of reserves in the U.S. banking system relative to the GDP, it's now crossing this gray area that is suggesting, one of two things are going to happen. Actually, we know one is definitely going to happen. And so the two things that have to happen here, the American financial system, it needs more bank reserves. So the way to do that, you're going to see quantitative easing coming back on. So that's where the Fed is. The first step was to stop QT, which they announced at the last meeting. And the next step, they're going to turn QE on. They have to. Because if there's not enough bank reserves in the system, remember, banks lend out as a multiple of their reserves. That's what they're doing. So if you don't have enough, if they're getting smaller and smaller, you can't lend as much. So then you're very selective of who you lend to. And then to bring this one step further, we talked about private credit quite a bit. And we continue to see standalone funds They're now all of a sudden they have to mark what the true value is, and these funds are either closing outright or they're having big drawdowns. So there's one story that continues to develop. I think it's called Blue Owl, and Rich, I think it's a European bank. It's one of the Swiss banks, I think, that own this.
Oh, you got me
this
there.
fund.
I can check it out.
Yeah, Blue Horseshoe doesn't love Blue Owl right now.
Blue Owl money machine sputters in face of private credit cracks.
So there headline news, and so as an investor, you got to piece all this together. So if there's not enough credit going into the system, then you're going to see cracks in this system, and this is exactly where it should be showing up first in the private credit world. So we continue. So this is a normal movement, but because there's not a lot of bank reserves on a relative basis for the American banking system, they need to pump a lot more into it. So they'll either do it as a reaction to something bad happening, or they'll be proactive and do it. Yes, Steve?
You'll love this. So it says Blue Owl has announced it was scrapping a planned merger of two of its private credit funds, backtracking on a plan revealed November 5th after scrutiny arose over the potential losses some investors would have to swallow as part of the deal. The parent company's shares had fallen this week to the lowest level since 2023. The CEO bemoaned, quote, negative articles about private credit that have caused its stock to sink. When it comes to Blue Owl's business development companies, the firm's co-founder said on CNBC, quote, there's no emergency here.
Yeah.
The fact that you're on CNBC talking about it sort of suggests there's something
Gave the game away.
Yeah. It's but again, these are the kind of things that we look at all the time when we're positioning portfolios, and it's been a very, we call it a risk on year, which means people have not been concerned about risk, really from May onwards. I think you're looking at that.
Yeah, Keith,
and now
every single industry group is up except for like 2 or 3 on the year.
Yeah, so now we're getting this turn, and so this turn so far, for the broad equity world, it's very mild. Like, this isn't something to be, hey, oh, wow, we should sell everything tonight. But continue when you wake up in the morning, don't look at the stock market, what it's doing. Use your latest AI platform. There's a lot of money going into those, but start searching. Secured overnight funding rates and the spread over the Fed funds and things like that. Because that's where you're going to see. So back for everyone who's here, 2018, that's when repo rates went from 2% to 10% overnight.
Was that the December 2018, wasn't it?
Yeah, I don't remember which month it was. So
Stock
it means there
market
either
tanked right
wasn't.
before Christmas.
Yeah, so there wasn't either enough collateral in the system, or there wasn't enough cash available to simply lend to each other. And where we're going right now, there's likely enough collateral because of the treasury issuance that's coming out. But if bank reserves are low, there's just not enough cash available for people to borrow. So this is, again, because you're seeing the private credit funds go off sides, the next step would be like a big hedge fund, to have an unpleasant experience. But these are the things that we should be watching. Yes.
I just wanted, sorry, quickly, I think with the other thing, what I think is really interesting. So there have been some sectors that have been really taken a bath, which is like some of the software sectors, like software and services down 8.2% year to date, autos down 7.3%, semis and semi-equipment. So there have been some subsectors that have done really poorly. But what I think is really interesting in all of this is that I'm surprised you didn't mention it, actually, because you've trained me to think about it all the time, which is the bond market. The German 10-year bond yield is up. The Canadian bond yields are up. The U.S. 10-year Treasury bottomed in late October, and that's up. And Japan obviously just keeps going to the moon. So it's interesting. You're not getting sort of that. How do you say, those safe haven flows into the typical.
It's really weird because for retail investors, everyone talks about their AI stocks, how much money they've made. But yeah, like in the institutional world, or sort of so-called thoughtful managers who are not completely all in on that world, it's been kind of a muted kind of year so far, and these are things that are really happening out there. But the what do we say in the intro, Steve, for the Loonie Hour? My voice goes on. Yeah, but my voice says something like, "People have the shortest memories."
Yeah, that's right.
That's sort of what we're like. So we're sort of lining. This is not perfect, but it's sort of, it's looking kind of like the end of 2021. That was the setup for 2022, which wasn't a very pleasant year. A lot of things are different, but one of the key things though was the liquidity, that was coming in to the marketplace.
Yes, there's a lot of talks about rebuilding the Treasury General account, and I'll probably bore people to death with that. But I mean, are we? Yeah, do you think we're shifting gears back to QE, or how does that sort of? I mean, how do the dynamics of this all play out?
Well, they definitely have to do QE because they need to rebuild bank reserves. So when the Fed does QE, they're buying the treasuries from the Treasury, who are selling them to JP Morgan, who sells it to Treasury. And JP Morgan doesn't get the cash. It gets deposited in the reserve account at the Fed. And by the way, Canadian banks who have U.S. subsidiaries down there, they have accounts at the Fed as well. So all that is there. But again, we're not trying to sound smart or nerdy or dorky, whatever it is, but this is what's driving the market right now. And we are at this point right now where someone big could go off sides, and then that will trigger a market reaction, and you'll see it. I mean, that will happen. If people will wonder, oh, why did this happen in the market? Oh, someone warned with earnings. That's not the case at all. Don't buy that story. It's because someone has went off sides underneath the system, and the Fed they'll have to come in up blazing again, provide liquidity.
Keith, it's already happening. Remember, Oracle tried to do a debt issue, and their credit default swaps are like quadruple or triple, or 5x the underlying tech index, which is incredible. Sorry,
it's happening. Yeah. And I mean, the other thing that we talked about as well, since the American housing market crashed back in 2008, 2009, the entire global financial system, the health of it is completely dependent upon a constant state of stimulus. That's it. As long as stimulus is coming in from government borrowing and spending, and then lower and lower rates, and then QE, everything is going higher. The moment they try to normalize their balance sheet, you want to think of it that way. So what would cause the biggest recession in the world? Was a lot of things would, but one of the things, if just say the Americans balance their budget overnight, the whole system collapses immediately.
You sound like AOC.
AOC. I don't want to sound like that, but again, like the world is in this constant state of borrowing. Like Steve, in your world, if people couldn't borrow, or they stopped borrowing, and they would only buy real estate with cash they've accumulated,
prices would fall dramatically.
Yeah, and like how many units are being transacted throughout the year? None.
It's all leverage. I think that's why you're seeing now is that prices are rebalancing. The cost of the debt went way up, and you can't borrow as much. So prices have to come down. They took a while to come down, right? It took 18 to 24 months for them to come down.
Yeah.
I think what's interesting, one little wrinkle I think that's really interesting is the rotation out of all of these, like the leaders. It's something that we look a lot is like leadership. So in the last 6 to 12 months, basically it's been all tech that's been driving the majority of returns in the S&P 500. And that's where I think you're seeing so much of this pain. And I think that for me is just really, really fascinating. That's why I think Bitcoin, we track Bitcoin with NASDAQ and all these different things. Sorry.
Yeah, it's interesting though, right? Because I think everyone was kind of like holding their breath for the NVIDIA earnings.
Yeah.
And they actually beat. But yeah,
Yeah, but
markets are,
they always massage them. It's like,
yeah. But I mean, markets are still down obviously today.
Yeah.
So
It's yeah. Anyway, so this is just it's just a fascinating time a year, and I think it was 2018. I remember
It
Christmas
was.
time.
Yeah.
Yeah, like December was. Maybe we're heading into that season again. But again, I know we're repeating ourselves, but the Federal Reserve are absolutely watching what's happening in repo markets right now, and they're trying to ensure that there's enough money to slosh around, and is a lot less in that bucket than it used to be.
QE, but for condos.
QE for condos.
I read somewhere that they wanted to go and buy up a bunch of Toronto condos. Is that true?
I don't know. I think it was someone's writing articles saying that the Canadian government should basically come out and buy these unsold inventory and then make them as long-term affordable rentals or something. I don't know. Never going to happen. But
well, hope not. But
well, who suggested it? Was this in the Woken Mail?
Yes, actually. Yeah.
I might have been, to be honest. Yeah,
they don't advertise with us anymore, do they?
No, they don't.
No. After Rich, let it rip.
That was my fault.
Yeah. But again, though, it's interesting that those stories they get floated, and it goes back to this sort of cultural shift that we've had now over the last number of years, 10, I guess, to be exact. Is the government should always be involved in the economy. Something goes wrong, government will get involved and fix things.
Yeah.
If something is going right, they're still going to get involved and end up unfixing it, I guess.
Keith, you know where they need to get involved? The Japanese 30-year.
Talk about that, Steve and Rich. Is we don't every now and then we'll bring it up, but why don't you just share how dramatic that market is?
Well, yeah, I mean, you guys have been tracking it, closer than I have, but Japan's bond market is 30-year yields are rising rather dramatically. I think, Rich, are they at all-time highs?
Yeah, well, I mean, the series high, sure. They're basically at all-time highs, yeah.
What do you mean by series high?
Because they didn't always issue 30-year bond yields, right? So that
right.
It's, and then now they don't really issue anymore, and there's all kinds of really nerdy, not relevant things for this conversation.
And that's why the 10-year is the benchmark everywhere, because the Americans stopped issuing a 30-year bond a while back as well, and then they had to go back to start issuing them again. But with Japan, I mean, they've decided we're going to let the currency and the bond market go. And that's
Keith. This reminds me of the possible trinity. Something we haven't talked about in ages. You can't have it all. She can either be smart or no. I'm joking. But you can either manage your currency, you can manage your monetary policy, or you can manage your capital account. And so what the Japanese are doing is just going to let their currency go. I mean, it's all related to this bond. But Steve, your point is well taken. Let's leave aside all-time highs. I mean, what's fascinating is that the 30-year bond yield for Japan is now basically within spitting distance of the Canadian 30-year bond yield, and that's basically never happened, which is amazing. So we're 40 basis points away.
You have the rough, and I'm probably putting you on the spot, but how much is the Japanese yen down over the last, let's say, 5 years against the Canadian dollar? The Canadian dollar has not been a strong performer, but if you just to kind of really illustrate the debasement.
If you keep tap dancing and buy me some time, I can tell you the exact number.
Drum roll.
So from 2020 to, you mean from 2020 basically?
Sure.
Okay.
Start of the pandemic, 2020.
So from start of the pandemic, it's 44%.
Sorry, the yen has fallen 44% against the CAD?
Yeah.
Yeah, that's crazy. I mean, I always find that interesting. I think in general, most Canadians probably don't notice or don't care, but I've noticed it feels like every Canadian I know has been doing vacations to Japan.
Yeah, yeah.
Well, I mean, it's
first
relative.
Of all, Japan is freaking amazing, by the way.
I've never been, but I've heard nothing but good things. But obviously, when you have a 44% move, it certainly makes it a little bit more appetizing.
Yeah, and just to give you an idea, so I just really quickly, so from 2021, January 1st, 2021, the yen is down, or I mean, you could say, it's basically
It's depreciated. Just say it's depreciated.
Yeah, excuse me, it's depreciated 50% against the U.S. dollar, or I mean, let's just say, yeah, basically 30-40%.
I mean, that sucks for those guys if they want to travel outside of Japan.
They don't. It's very
nothing to worry about. Then.
It's a very insular culture. I mean,
come to Toronto.
They're not interested.
But the reason, yeah, okay, you jokers. But the reason that we talk about Japan, because they are the second most indebted country in the world. They issue the second amount of Americans issue the most debt, and Japan is number 2. And if they have a problem in their bond market and it breaks, it is going to swamp the world with a challenge. Mm-hmm. So again, this is, and when Steve said, hey, in the 30 years, I think we're at 3.4. I think we are now with the Japanese 30 year. Mm-hmm. It's it's still going higher. And where's the yen now? Like 156, 58.
Yeah.
In that range, right?
Remember they were supposed to raise a lot of questions that I have to look up today. Jeez.
Yeah.
Please.
Remember they were supposed to raise rates.
They're not raising rates. That's not happening.
They talked about
it. They tried to, and it just didn't work.
What did they get? They got like 25 basis points of hikes in, didn't they?
Yeah, but over like a year. That was like three separate hikes.
10 basis points at a time.
They did 10 basis. Sorry, I lied. It was like, anyways, whatever. It was like three separate hikes, but in that whole 6 or 12 month period, it was up 30 basis points or something like that. It was ridiculous.
They're sitting at what now? 0.025?
Oh, Jesus.
Overnight rate? Barely positive.
Yeah, it's barely positive.
Inflation's running a little bit hotter there too.
It is 2.5%. But I mean, it's just fascinating, right? Because their population is declining. I mean,
yeah.
This is to bring it back to Canada. This is why this idea that you can just spend with impunity forever while having zero productivity growth and having 42% of your bonds being owned by foreigners and making your country impossible to invest in because of all these stupid laws, which we knew in advance were dumb and they jammed them down our throats anyways. Eventually it will catch up with you. And so, and this is why pay attention to the currency. The fact that Canadian dollar is down against the basket case that is the UK, which has all these similar issues, is fascinating. I mean, you cannot devalue your way to prosperity. To quote my old boss Luca Paolini, you know what I mean? And Japan is trying to, and in a way they maybe can get away with it because they own so many assets around the world. 95% of their bonds are owned domestically. It's a hyper homogeneous culture. There's probably maybe 1% non-Japanese people who live there. It's a different world, but for Canada, I don't think we can get away with that.
We're the best in the
G7. Maybe if we liquidate the pension funds, we can pay down our debt. I mean,
but it's kind of the old adage that Keith always goes back to, right? Which is like, let's be honest, every country is going down this path.
Right.
Nobody wants to be the guy that sticks out or shifts course. They're all just kind of joining hands and singing Kumbaya, and they're all going down together.
Yeah. It's like, what is it called? It's like, not Duck, Duck, Goose. Musical chairs. Keith, did you play that game in 1932 at your one-room school in in Newfoundland?
Yeah, it was also getting close to winter, but every morning we went to school, everyone had to bring one piece of wood with them for the wood stove.
No way. Is that actually real?
Yeah. Every kid used to bring one piece.
No, come on, Steve. That's not a real story.
Might be.
But
it is true. That used to happen in the old days, by the way.
Pre your time.
But no, that's just like one last thing. Your point is well made. Like that, the fact that the 30-year bond yields aren't going down, the fact that the 10-year bond yields aren't going down, even though markets are down, whatever, 4, 5, 6, 7, 8%. It just tells you there's something different. This is the famous last words of a macro strategist, and that this time is different. Keith, are we allowed to say it? I think this time is different. I don't know.
No, I don't. Yeah, I don't think it's any different. It's just that in our lifetime, we haven't experienced it before. That's
Right.
all.
Right.
And
That's better. That's better. Way to
yeah,
say it.
and it is so, Steve won't want to hear this, but the mortgage experience we've had for the last, from 2010 to 21, think of it that way, that will never be repeated again. Like people who think rates are going to go back and there's like 2%, like that's gone. That was a period where the whole world, they suppressed the cost or the price of money, the yield curve. That's what they did. And that's now out of it. Like that genie is out of the bottle. They are not going to be able to get that back in again. And everyone is setting their expectations on what should happen with different economies and markets based on this fantasy land experience where we had zero rates and negative rates and QE was going into every system and, economies were growing. And now all that's turned at the exact same time for everyone around the world. And, it's kind of exciting, from an investment perspective, because you can see what's happening. And until it happens, people will say, oh, this is slow moving. This doesn't matter. Don't worry about it. And then when it does happen, every single person is going to say, oh, yeah, this was easy to see. We saw it coming. So
Keith,
maybe next week, we're going to say, see, we talked about it last week.
Keith, can I ask you just
but the plumbing of the system, it is suggesting that it's a bit tight out there right now.
Shitter's full.
Wait, before we go on, I just have a question. I just have a question because you've mentioned like the race to zero. And I think we've gotten questions in the past, but why we always talk about the race to zero and monetary policy being cut and cut and cut, and yet at the same token, you say that we're never going to get that same mortgage experience of the ones and twos. So can you just quickly touch on why those two things are not contradictory?
Yeah, absolutely. So the race to zero. This is my belief, okay, or expectation that the economies around the world are going to deteriorate more than where they are right now. So that's not good news for some people, but it is what it is. Central banks are going to say, screw fighting inflation. I have to save our economy, have to save the housing market and all that. So they will cut overnight rates. If they don't go to zero, they're going pretty low, close to the one number. The rest of the yield curve, that is going to react to all the debt issuance that's coming out, as well as sticky inflation. As soon as the bond market realizes the central bank, they don't care about inflation anymore. All of a sudden, the long end of the curve, or the 5-year, 10-year, whatever you're looking at, those yields are going to explode higher. So then you have something at the exact same time, the economy is deteriorating, bank loan portfolios are starting to weaken, and they're trying to decide, okay, who are we going to lend money out to? They're going to be very selective about it, and they'll charge more for it. And that's where you'll get higher rates. That's why I say, mortgage rates are not going back to this experience we had, but overnight rates will.
Thank you.
And that's a good place to end it. You'll be able to learn more at the Toronto Investor Series. Again, I won't be there, but Keith, Rich, and Ben will be. I think it'll be a good time. And there'll be a link again in the show notes for an Eventbrite page to grab your tickets. But as always, guys, hope you enjoyed the show. If you did, share it with one friend, family member. Help us continue to build the Loonie Hour community. And as always, we'll see you next week.